Welcome to a very special episode of Honest Money. We're actually joined by one of the Honest Money team, Tami Dal, whose responsibility is content in our business. Welcome, Tam.
Thank you, Warren. It's very stressful being on this side of the hot seat.
So before we started the recording, you said you're having an adulting experience?
That's exactly it. The 30s are a little bit too close and they're waiting for the adult card. So now I have to get serious about being an adult.
So one of the joys of becoming an adult is not necessarily doing podcasts, but definitely talking about money and starting to learn about money. And what's interesting to me is kind of watching your journey as you've been with us on the show, that it's gone from something that's kind of just something out there to now it's in your life and it's in your bubble, and it's something that even if it's not your most favorite thing in the world that you want to worry about all day long, it's something you need to do, right?
100%. I think this is also why I'm so proud to be on the Honest Money team and work for it, because it's changed my life so much in such a short amount of time. And obviously there's been a lot of jargon and terminology and a lot of conversations that you've had that I've listened to that I don't quite fully understand, because I'm trying to find that basic foundation point first. And obviously this is why I've come to you now, because who best to ask but you, Warren?
Okay, so let's kick off. So what's the kind of first thing that's not bothering you, but the first thing that we need to explain and need to get you on your path?
Cool. So basically, I know that step one to being on your financial journey is to try and pay off your debt, which I've done, have a emergency fund saved up, which I've done, and now I actually want to start my investment journey. I downloaded Easy Equities because obviously we've spoken about it a couple times on the show. We see it a lot on our Twitter account. And I downloaded Easy Equities and was completely overwhelmed. Had no idea where to start, how much I should put in the beginning, how much I should play around with first, sort of those kind of questions.
Okay, great. So let's not tell everybody exactly how much you earn and how much you save and things, but let's talk about the general guidelines to make sure that everybody can do the same sums for themselves. So I think the how much should I save question is something that's going to be different for a lot of us, but the way we get to the answer is the same for everybody. So I think the first thing is it will be determined by how quickly you want to get to financial freedom. And for everybody, if you said, okay, when would you like to be financially free? Firstly, I guess we have to just explain what that means, because that will also be different for everybody. But there are some real trade-offs that you need to make when you make that decision. So just very quickly, what's financial freedom? To me, you've already hit 2 out of the 3 steps. So step 1, become debt-free. Step 2, make sure you've got an emergency fund which covers 3 to 6 months worth of your normal expenses. And then the last step is then, okay, I now need to get enough investments that can pay me an income to cover my monthly expenses, so that any work that you're doing, once you've hit financial freedom, you're working because you choose to, not because you need the money to pay the bills. So why you need to make some trade-offs now is, if you said to me, look, I'm rapidly approaching 30 and I want to be financially free at 35, then probably it's not possible is the short answer.
Yeah.
But if you said, look, 40 or 45, then the truth is that is possible, but it means you need to make some real material trade-offs now. And trade-offs, I mean that you need to say, well, almost, kind of out of every 100 Rand that I earn, I need to put away 66 Rand into my savings and actually invest that money. And the balance I can live off. And for some people, that will be it's just going to be way out of line. They're just not something that they either can do or that they're prepared to do.
Yeah.
So then the trade-off is to say, well, okay, if 45 is not a possibility, what about 50 or 55?
Yeah.
So then you can start to move on that scale. So you can start to say, well, okay, I think I can probably save kind of half of what I earn, and I really want to kind of get to financial freedom as fast as possible. I mean, saving half of what you earn is a huge number. Most people can't get that right. So I think that first thing on the scale, Tam, will be kind of when you want to hit your financial freedom goal.
I really do love my job, and I'm totally not just saying this because I work with honest money. I really do. I like working, and I'll get bored very quickly. So I really do want to work until I'm probably 55, 60, but not highly strung work where I have to have a job where I'm freaking out about money all the time. So I think it's just to make sure that I can retire comfortably, and I would be able to make that decision from 55, 60, that I don't have to retire with all these worries and these stresses.
Okay, so that for me feels like a very attainable goal for someone who's starting where you are now in terms of debt-free emergency fund already. And then I'm thinking that out of every 100 Rand that you earn, we're talking probably about saving 20 out of every 100.
Yeah.
So as a starting point, that's what you need to kind of aim for. And just to remember that 20 out of 100 is not the money that includes saving for the next trip, the next car, all of that. It's pure long-term, building up money. So I think that if you're happy with that, then I think we're starting to get to kind of at least making that first calculation, which is, okay, this is how much I need to set aside. Okay. And then about where. So I think there's certainly nothing wrong with easy equities as a place to start saving. I think we just need to talk about what you choose there. And as you say, it's a bit like walking into a huge macro, right? I mean, the ingredients are all there, and now you've got to get your own. If I want to use like a master chef mixed with macro analogy. So now you walk in, there are more ingredients than you could possibly use in your lifetime, and now you need to get the menu that suits you.
100%, yeah. And that's exactly what's daunting, is because you kind of see, like, you obviously see the Satrix top 40, you see all these listings, you see all this data and the stats, but if you don't really know how to navigate it's quite hard to get all those ingredients together.
Okay, so I think that the two things to think about is when you choose your kind of core investment. So when you're starting out, the first investment that you're going to make, as far as I'm concerned, should be kind of the real core, the real foundation of how you build your long-term investment portfolio. Okay. And that core, I think, should be largely invested in shares. It shouldn't be something where you've got a lot of money in cash or a lot of money in bonds, government bonds or something like that. Because at your age, what you really need is you need to give your investments as much time as possible to grow for as long as possible. Okay. And the investment which gives you the best return or the best growth over long periods of time will be shares as a general, as a general asset class. But the trade-off is that they come with enormous kind of a rocky road where you're kind of on the craziest roller coaster possible. Yes. So the only way to kind of manage that roller coaster of the stock markets is to give yourself a lot of time. Okay. And
so this is definitely long-term.
Exactly. So you need to say to yourself that this is my kind of 45 to 50 money, and I'm going to set that aside now, and I'm going to add to it as much as I can and give it as long as possible to grow. Okay. Got you. Okay, so now we've cut out maybe half of all the things that you can possibly buy on that platform, but that's still a lot of stuff to buy. And then I think it's a case of saying, if you're going to choose shares, then just understand that, we're always going to talk about the health warnings of investment. So that one health warning to understand here is when you've got your first 10,000 Rand saved, there is going to come a month or a year where your 10,000 Rand is probably worth 5,000 Rand. Okay, and I'm really sure we're going to be doing a show there where you're going to be much less happy with me and much more aggro because now you've lost half your money. And the thing to remember is that's the benefit of being in the stock market, is it's going to do that to you. But if you stay invested, you stay calm, the down gets recovered and you get back more. You actually will grow further than what you've lost.
So then is there sort of like a rule of thumb or anything to follow in terms of like, how do you know when to take your money out? Because obviously if it is long-term, it does need to stay, there does need to sit. But is there a certain turning point, or is there sort of data that you need to continuously watch and make an informed decision of when to pull it out?
That's a great question. So my view is, if you were buying individual shares in individual companies, so you were buying a Microsoft or a Naspers or a Pick and Pay or whatever, then you need to be really active and really monitoring what you own and take a lot more daily interest in what's going on. But if you're buying, I mean, you mentioned the top 40 index as an example, there's very little you need to worry about, because that index will chop and change inside the investment without your concern. You're not going to be worrying about what's going on in the index. You're worrying about the whole index, and you're worrying about what value it represents to you. So my view is that you don't need to worry about that. The next time you plan to sell it is when you start to draw some money out of it, because it needs to pay you an income.
Okay.
So I think it's as close to fire and forget as you possibly can find. But I think we, like any good cooking show, we can't just have one ingredient, right? So if you're going to do this, then I think you need to at least have two investments. One is, and I think there's nothing wrong with that top 40 index, but I also think you need a world index to add to that. So just briefly, you need something that says, okay, I'm going to have a portion of my money in the South African stock market. This is where I plan to live, where I plan to spend my money and time. But I also need to have exposure to other markets, so that I get exposure to other currencies, other countries, other kinds of investments that you just can't buy in South Africa, like the big tech companies, the pharmacy companies, etc.
Okay, I was actually going to ask you, offshore versus local. I mean, when do you know? And like, especially now starting off this journey, do you think, is it advisable to maybe find my feet in the local top 40 first, and then once I'm feeling a little bit more confident, then I go to the international side? Or should I do both at the same time? Do I split my money 50-50?
I always like to split my money half-half. When I don't know what to do, I go 50-50. And when I'm starting out, I go 50-50. So I think, out of every 100 Rand that you're going to save, allocate 50 to the top 40 index and 50 to the world index. The only time that changes is if you said, I'm probably going to spend a lot more time and therefore a lot more money overseas than I am in South Africa. Then rather bias the portfolio to overseas. But in the starting point, I would say, no, go half-half. Okay. And just focus on building that up, gradually, and where you can, if you get some extra lump sums, put in the lump sums as you can. But otherwise, try and do a monthly amount on. If you're not doing debit orders, one of the mistakes people make is that they put money into their account and then they wait and they try and guess where the markets are going. So my view is, if you're not doing a debit order saving, then just say, on the 5th of every month, whatever it is, I'm going to put the money in, I'm going to close my eyes, and I'm just going to buy. I'm not going to guess what's going on in the markets, because the truth is, none of us know what's going on.
And then would it be a safer bet to invest in companies that I know? So your big banks, all of that stuff, or is it much of a muchness, whatever's on the top 40, I can trust that my money is not, it's going to be safer there? Yeah,
I feel it's quite a tricky game to be in the job of selecting individual companies or individual shares on the basis that you or I have some kind of knowledge that we've got an advantage over the markets, over everyone else that's out there. So I mean, just to think about in South Africa, if we decided, okay, we're going to buy one or all of the banks in South Africa, we're saying that we know more than all the pension fund managers, all the unit trust managers, all the hedge funds, all of that. We have done better research than they have, and we have better knowledge than they have about what price to pay, when to buy, when to sell, all of those things. And the truth is, the best unit trust managers, the best pension fund managers and hedge funds don't even know. So my view is rather buy the index. It'll own most of the big companies in South Africa and some other companies as well. And then when you own the global index, the same story. And it takes a lot less effort from you to do that than now try to be in the game of share selection.
100%. Okay, perfect. So in the grand scheme of things, it would be 50% into local, 50% into international. And it would literally be me investing in the top 40 or whatever the case is, and leaving it there for the next 20 to 30 years. If there is a drop, don't sell it, don't freak out, just leave it.
In fact, if there's a drop and you've got some extra money, get greedy and buy more.
Oh, really?
Because I think that's the thing about, as a consumer, whenever there's a big sale, we all want to buy more, right? And as investors, when there's a big sale, which means the markets have collapsed, then we get all afraid and we start saying, no, we want to wait till the sale's over, until the prices are at their absolute highest, and then we want to buy again. And that it doesn't make good behavior as an investor. So as an investor, you want to kind of do the opposite of what everyone else is doing, which is you want to be greedy when everyone else is fearful. And that means buy like crazy when you know the markets have taken a drop. But having said that, if you just do a straight monthly amount or a straight debit order, and you increase that every year as your income increases, that's really all you need to do. I mean, I think we overcomplicate the saving game. There will come a time when you're, let's say you're sitting on R1 million worth of savings, where we need to say, okay, hang on, let's look at your overseas portfolio, for example, and maybe add an emerging market index tracker to get a little bit more variety, or something else. But I think to kind of start where you are and do the monthly amount and just let it build up and build up and build up until you get to R1 million makes all the sense. I don't think you need to be too fancy with diversified investments or individual shares.
Okay, yeah, I think that's the thing that it gets a bit confusing, because obviously when you do start researching before you start your investment journey, there's a lot of conflicting advice. So it's and then there's short-term investments and long-term investments, and you don't know where you should dabble in, especially in the beginning, because it is very scary, especially if you don't understand the terminology and if you don't understand how everything works completely. So it is a learning process in the beginning. And Warren, in terms of in the beginning, again, while I'm trying to find my feet, would you still suggest that I would put in for every 100 Rand or whatever, it would be 50-50? Do you suggest that I do that right from upfront, or should I put in like 1,000 Rand or 2,000 Rand a month and then start increasing it? Or would I go straight in with the money that I have available?
The truth with savings is that the more money you can get actually committed to investments, the earlier, the more you're going to benefit over time. So the faster you can get your money into the markets and get it working for you, the better. So there isn't, in this way, I don't really think there's a way you can dip your toe in and gradually, like getting into a cold swimming pool. The best way to do it is jump in, head first. And I think the same with investments is you just got to make sure that you get the money working. And there are a whole lot of cliches, that kind of older guys like me in the markets always kind of spew out. But one of them is about time in the market. And that's the key here, is the more money you can get into the markets and the more time you can give it to grow, the more your money starts to make money babies, to use one of those bank ads. So I think that to me, that's the thing to do here.
Okay, perfect. And then last question. So downloaded the app, got some money sitting there, but now there's a tax-free savings account and there's an ETF account. How do I do that split? What should I only have all my money in my ETF, or should I have 50-50 again? Like, what is the right ratio in terms of that?
So the tax-free savings accounts to me are really powerful, really great investments actually. So I would try and maximize the amount that you can save in there. At the moment, it works out to 3,000 Rand a month or 36,000 Rand a year. So you can definitely buy both those, the top 40 and the world index inside an ETF. And that makes all the sense to me, to try and maximize your allocation to ETFs, to the tax-free account first, and then to an ETF account after that. The only thing to remember is money that you put into a tax-free, if you draw it out, which you're allowed to do, you lose the amount that you've drawn out over your lifetime. So just to explain that, over your lifetime, you can do 36,000 Rand a year to a maximum of 500,000 Rand. So if we get down the road and you draw out 100,000 Rand of your money in your tax-free savings one day to buy a car or something like that, you can't put that 100,000 Rand back in again. So you've now lost the lifetime capacity. So when you ask that question, I mean, it's, the standard answer will be yes, maximize your tax-free, but you also need to be realistic to say, well, maybe some of my long-term savings I might need to access one day. I don't know why, but I need to be kind of protected just in case I need to do a deposit on a car or a house or something like that. And so what I would say is, maybe there you should go half as well. So, if you've got more than 3,000 Rand a month to save, great. Then you do you can do a split. But if you don't have 3,000 Rand a month, then maybe do 1/5 into the tax frees, 0.15 into the ETF account, but still, go half into the world and the top 40 index.
Oh, thank you so much, Warren. It's so nerve-wracking when you work so hard for your money and then you put it into something that you don't really understand. So just finding that trust is quite stressful in the beginning. But I know that once you find your feet and once you start understanding, it's a lot better. But having these beginner tips really, really help. And it actually just puts my mind at ease. And I'm sure a lot of listeners as well.
So what I'm looking forward to is the next show. Once we've lost you half your money and the stock market's crashed, and then let's see how much you love us then. But I think that you've got the right attitude. It's time on your side. Be patient. You're kind of letting compounding work for you if you're just patient with the money. And it'll be great. Actually, we should do these every now and then just to see how it's going and. Whether you're actually making money or whether it's falling apart around you, and then it's the same journey that a lot of other people will be having. So it'll be awesome to share the experience.
Thanks, Warren. I really appreciate it, Joe. All my close circle, every time I go and ask for advice, everybody's like, I don't know, Google. So that's when I went to Steve and I was like, Steve, I need help from Warren. I have no idea what I'm doing. Thank you, Warren. This definitely helps.
So thanks so much, Tam. I appreciate your bravery on coming on air, and I'm sure the listeners will tell you that you were great.
Oh, very honored. Thank you, Warren. Very, very honored. Thank you. I really appreciate it.